So does buy to let still work with 6.5% mortgage rates? Now, a lot of people at the minute are very fearful about investing in property. A lot of people are exiting the market, landlords are selling up, and a lot of people are saying that buy to let is dead. Now that we know that interest rates have sort of settled down between 6 and 7% for a buy to let mortgage, we're going to find out if it's still viable and if it's still worth the investment. Because I personally think it is. I've been into property for many years. Obviously there's going to be ups and downs, but I see this as a good opportunity, whereas a lot of people don't. So I'm going to run through the figures and just to compare it with previous years and to see if the buy to let investment is still a viable one. Also, if you have an opinion or you've got any questions, please leave them in the comments below. And also don't forget to check out my Instagram channel where there's lots of other extra info and advice. So please be sure to follow me on there. Okay, back to the video. 6.5% mortgage rates. Now this time last year, it was completely unheard of. Nobody thought we were going to be reaching interest rates this high, this quickly. However, it's here, it's happened, and we have to just crack on and get on with things and deal with it as it comes. Now obviously, higher interest rates is a kick in the teeth for landlords and investors. And higher interest rates mean higher mortgage payments every month. This is just one variable that has changed and it's out of our control. And when one variable changes, other variables tend to shift as well. So for example, yes, interest rates have gone up, the mortgage rates have gone up, which means the payments are higher. However, other variables such as the rent you can achieve has also gone up. And also we're starting to see property prices to fall. So these two variants are changing in line with the rise in interest rates. So technically it should work out okay and we should still see buy to let as a viable option. Now I've got a number of buy to let properties. Some of them are on 5 years fixed at around 3.6%. Some of them are on 2 years fixed at around 4.7, 4.8%. And I also have one or two coming up for renewal anytime now. I am in the mix of things. I do have a lot going on. I am at both ends of the scale in terms of interest rates. So let's have a look at what happens to an investment when we use a 6.5% mortgage rate. So based on a purchase price of £100,000 and a mortgage rate of 6.5%, obviously we'll be borrowing 75% of the loan to value. So at 6.5% mortgage, our monthly mortgage repayment costs would be an eye-watering £406 per month. And you'll also want to work out a rental cover, usually either 125% or 145% of your estimated income from your rental. So let's say in this example, we bought the house for £100,000, we're going to rent it for £600 per month. Now let's say with this example, usually the area that I'm in, if I bought a property for £100,000, the rent that I'd expect to achieve would be around the 575 mark, 550 maybe. But now the interest rates are £406. This clearly is not a viable option. You wouldn't want to be forking out £406 per month to bring in 550 because after other expenses, you're probably left with no profit. So as I mentioned at the start of the video, some variables need to change, they need to shift. So that means the rent has to be higher or the price that we buy the property has to be lower. And we are definitely seeing both of these variables changing quite a lot, in fact, because rental demand is the highest it's ever been. People are queuing up to rent houses. I've also seen a shift in property prices. They are starting to fall. I've even had a property myself recently where I've managed to get it at a big discounted rate than what I originally agreed the price upon. So prices are falling and rents are going up. Now this is a strange correlation because you think that rents would go in line with the property market. However, they're not. We're seeing rental yields rising, which means higher rents, lower cost on property. So in this example of £100,000 purchase and £550 rent, that rent now needs to be at least £600, probably more towards £650. Or we need to negotiate the property price lower at say 90 or maybe 95,000. And if you think this is not achievable, it definitely is. Up until 3 months ago, no it wasn't. You would not have a chance on this earth of negotiating a property £10,000 lower than the asking price. However, with the interest rate change, cost of living crisis, the whole outset of the property market has turned. So it's now a buyer's market, which means yes, you can go and negotiate prices, you will get discounts, you will get a lower price than what the estate agent is marketing the property for. So let's tweak this example now. And let's say it's £90,000 purchase price and we're going for a £600 per month rent. So at this new purchase price, our monthly payments have now changed to £365 per month. And if we can achieve 625 rent, that leaves us with £265 profit per month before tax and expenses. Now this is looking a little better. It's looking a lot more like it was pre-property meltdown, whatever you want to call it. So just by changing these two variables very slightly, which is happening, I'm not just making this up, you can go and achieve lower priced properties, you can go and achieve higher rents. So just by tweaking these two variables, we can see that the buy-to-let investment is now turned into a viable one again. Now these figures also fit in with the rental cover that the mortgage lender will request. This is based on 145% cover. So to calculate the rental cover, you simply take the annual interest amount and then you times this by 145%. This will then give you the yearly figure which you are required to be able to achieve in rental to be eligible to receive the mortgage. Now, as I said at the start, there's a lot of fear going around. A lot of people are exiting the market. I think it's just a brilliant time for a new era of property investors to step in. Obviously, it's different than it was before. Everything's always different than it was before because things evolve, things change, and like I say, people will exit the market, people will enter the market. Now, people that are entering the market in the next year or two are going to be in a good position to buy properties at discounted prices. I have no doubt that there'll be a lot of repossessions, there'll be a drop in prices, and there will also be a lot of landlords selling up because they simply don't want the extra work. Maybe they've been in the game for a couple of decades or more and now they feel it's their time to exit. However, this doesn't mean that buy-to-let doesn't work, it just means that it's their time to leave. Whereas for you, for example, you may be younger and it might be a good time for you to enter. So, hope you enjoyed this quick video. As I said at the start, please leave some comments below. It's always a good topic to discuss. I'll also do my best to answer any questions. I'm Jason and I'll catch you soon.